at how we are going to handle how we record the various accounts when we use a periodic system. So everything we talked about was related to this perpetual system where we keep updated after every transaction where our inventory is, how much we've sold. A periodic system is where we don't keep track of anything until we count our inventory on hand at the end of the period. Okay? So how do we keep track of the purchases when we sell goods? How do we do all this? We don't keep any account of changes in inventory. We only count our ending inventory at the end of the year to determine what's on hand. And we don't even figure out our cost of goods sold till the end of the year. So, the way in which we determine the cost of goods sold at the end of the year, we're going to start with our beginning inventory balance. We're going to add to that all the purchases that we've made during the year. And then with those purchases, we might have some purchase returns and we might have some purchase discounts that we're going to subtract from our purchases to come up with a net purchase. We're going to add to that any freight we had to pay to get goods to us. FOB shipping point means we paid for the goods. Free on board destination means the seller pays for those goods. Free on board shipping point means we paid for them. Then we show all the cost of goods purchased, what's available. After we take our physical inventory count at the end of the year, then we know what our cost of goods sold is. Periodic method, right? So, Aerosmith Company's accounting records show the following at the year end, December 31st, 2014. It gives us our purchase discounts, our purchases, our ending inventory, our freight beginning, and purchase returns. We are supposed to figure out the cost of goods purchased and the cost of goods sold. What's the first thing we're going to start with, guys? Beginning inventory balance, 18,000. What are we then going to add? Purchases. Purchases are 162.5. Then we need to show our purchase returns and discounts along with our freight in, because that's a cost of our purchases, right? So 160,000 are the cost of goods we've purchased during the year, right? Then we show the beginning inventory along with all of our goods purchased. Goods available for sale, 178. What are we going to do next? We're going to look at our ending inventory because the rest we sold. Okay? Know this, guys. Know that our purchase returns and allowances and purchase discounts get subtracted from our purchases, and we have to add our freight in here. So the gross profit rate is basically determined by dividing that gross profit by net sales. So if you look at my example over here, the gross profit is 300 divided by 1,000. What's that going to be a gross profit rate of? 30%. So the way we calculate the rate is dividing the gross profit divided by sales. A decline in the gross profit rate might be because we are having a lower markup. There might be increased competition, so we got to reduce our prices. Company forced to pay higher prices to suppliers without being able to pass these costs on to the customers. So that gross profit rate is really showing how much more we're selling the product for than what the cost is. And why would it go down? We don't want it to go down. It usually goes down because we don't have a choice. Higher competition, lowers the gross profit. The suppliers up their rates, we can't pass it on. Make sense? So the gross profit rate really is determined by the gross profit amount divided by total sales. So, as you see here, REI, if you take their gross profit divided by total sales, REI in 2010 had 43.9 gross profit. In 2009, 44.7. Look at Dick's, 29.7 and 34% is the industry average. What the heck is REI doing?
They sell higher quality, higher markup items.
They do sell higher quality, but they pay more for it.
Yeah, but I think they're able to get away with charging more, maybe.
We somehow put up with going there and buying the goods, don't we?
I mean, I had somebody for Christmas, they were trying to buy someone a $700 sleeping bag. I'm like, are you kidding me? I'm like,
Yeah.
Who does that?
if you're a heavy duty camper, I guess.
So the profit margin ratio measures the percent of each dollar of sales that results in net income. So what's the difference between gross profit rate and profit margin ratio? The gross profit rate measures the margin by which the selling price exceeds the cost of goods. Okay? The profit margin ratio measures the extent by which selling price covers all expenses, including cost of goods sold. So let's look at this. The profit margin is taking into account net income, not gross profit, but net income divided by net sales. So isn't this interesting? REI in 2010, their profit margin after all their operating expenses show 1.8 and 2% profit margin. Look at the Dick's and the industry average here, 3.7 and 5.1.
So could that be paying employees more? Could it be
Operating
higher
is
rents?
higher.
Maybe they have to have a taller building for that climbing wall, so that's more heat or something. I don't know.
So
All of it.
Yeah.
So that's net income divided by what again?
That's it.
net sales, where the other one was profit, or gross profit divided by net sales. So basically, the two speak, basically what it shows is they're making a better profit on their goods, but their operating costs are much higher than the industry average. They might pay their people better. That would be an interesting item to research. I remember when REI was just a little store in Bloomington
Was that
in the
the first one?
80s. What?
Was that the first one?
Yeah, and look at where it's at now. It's nationwide.
Well, think of a small amount. Think of if Dick's is paying everyone $10 an hour and REI pays anyone $12 an hour.
Makes
that's
a huge
20%
difference.
difference right on labor right there. Or if they have more people working to give better service.
It's a
Also.
co-op.
Or if they pay
REI
out
is a
commissions
co-op.
too, which
It is. Well, it's costing more, So keeping an eye on cash. Earnings have high quality if they provide a full depiction of how companies are performed. A measure significantly less than 1 suggests a company may be using more aggressive accounting techniques in order to accelerate income. A measure greater than 1 suggests the company's using conservative accounting techniques. So basically, quality of earnings ratio is helping you see how, again, all of these are comparisons between companies or between years. So net cash provided by operating activities divided by net income really allows you to see how much of their money is coming from operating activities, not from other sources. So, how do we, under the periodic system, record the purchasing of merchandise? So, our various merchandise transactions. So when a sale occurs, we're going to record the revenues when the sale's made, which is realizing, that's when you realize a transaction. We don't record the cost of merchandise sold because we don't keep track of it till the end of the period. The physical inventory count at the end of the year is going to determine the cost of merchandise on hand, and ultimately we'll then be able to plug in the cost of merchandise sold. We're not going to record purchases into inventory like we did under the Perpetual method. We're going to record them into an account called purchases accounts, and we're going to also use purchase returns and allowances and purchase discounts and freight. So the key here is perpetual versus periodic. We're using different accounts. Under perpetual, we pretty much tag inventory to everything. Our discounts, our returns. But under this periodic method, we're going to use some different accounts. On the basis of the sales invoice and receipt of the merchandise ordered from PW Audio Supply, SOC records the $3,800 purchase as follows: debit purchases, credit accounts payable. Remember, under the perpetual, we debited inventory, didn't we? If SOC pays freight, $150, we're going to have a separate account, freight in, $150 cash. Remember, under the perpetual, we stuck it into inventory, didn't we? SOC returns $300 in goods. We're going to reduce our accounts payable, and we're going to credit purchase returns and allowances, so we keep track of what's been returned. On May 14th, SOC pays the balance due on account to PW Audio Supply, taking the 2% discount. SOC Stereo records it. We're debiting our payable. We're going to show a purchase discount, and the rest is cash. This is all under periodic. When PW Audio records the sale of the $3,800 of merchandise, we're going to show a receivable, and we're going to show sales revenue. We're not going to do anything with the inventory because under periodic, we only show it at the end of the year.